Good afternoon. Thank you for joining today's webinar. My name is Phil Quinn, National Account Manager at Pepper Money, and thank you for TFC Home Loans for organising today's webinar. I'd like to talk to you about the specialist market, tell you where it's at, where it's going, and I'll tell you a bit about where both TFC and Pepper can help with those interesting cases. So firstly, let's take a look at the specialist lending market. Well, what we know is that year on year, over the last 4 years, we've seen an increase in the amount of specialist lending business being written. It's actually grown 33% over the last 4 years. Last year, £24 billion was written in the specialist market, and that's expected to be higher for the end of 2019. What's great for you and I is that we're now starting to see more and more business being written through intermediaries. So in the direct market, direct to lender, it's fallen 3% over the last 4 years. And therefore it's increased 3% through the intermediary market. So more and more business, especially in specialist lending, is being written through intermediaries. So what's making up this demand for specialist lending? Well, firstly, we know that 15% of people are self-employed. Of course, self-employed brings its own complexities. Great to see so many specialist lenders offering different solutions to help those applicants. In Pepper Money, we've seen a 36% increase year on year in complex income. So this is applicants who have multiple sources of income, different varieties of income. We're able to take 100% of all of it if it's regular. There's also been a 25% increase in equity release year on year. And a real positive to see that first-time buyers have continued to increase at 5.8% growth in July 2019 compared to the same period last year. And actually, let's think about why our first-time buyers increased. Well, first of all, we know due to the schemes. Help to Buy, Right to Buy, shared ownership, there's a lot more assistance for people. We've got Bank of Mum and Dad. Actually, the 9th biggest lender, Bank of Mum and Dad. So people want to get on the property ladder, they just need a bit of help. And what we also see is that due to the changes of taxation for landlords, more and more landlords are offloading properties. So it's superb for first-time buyers, they're able to take them up. Here's the one that gets me. 2% rise in UK total household debt. Let's explore that in a bit more detail. So if we take a look at the number of CCJs that have been registered over recent years, 1.1 million will be registered this year, the same 2018, the same in 2017. All of these applicants who have registered CCJs will potentially struggle to get a high street mortgage. Great to see so many specialist lenders who are able to cater and help these applicants. Now, what we know is the average value of a CCJ stands at £1,400. So the trend is quite clear to us. The volume is increasing, the value decreasing. Back in 2008, the average value £3,500. So what we see is A, easier for companies to apply for a CCJ, and B, they're now applying for CCJs for less significant issues, such as TV license, council tax, parking tickets, mobile phone contracts. If someone has a £60 parking fine that they've not paid in 60 days, it can result in a CCJ. Are your customers aware? How can we educate? How can we make them aware? But of course, the rise in CCJs is just one piece of the puzzle. There are so many other ways where people trip up, and let me share that with you. So firstly, credit card debt standing now at £2,600 per household. Store cards and credit cards. In September this year, we spent £11 billion. What will it be in November? What will it be in December as we approach Christmas? People are spending and getting carried away. Utility bills over £4 per day per household. And 0% big ticket finance is just another reason where people get carried away and trip themselves up. Yeah, I'll go to DFS today because guess what? They've got a sofa sale on. £2,000 for that leather sofa I dream of. 0% for the first 2 years, no problem. Fast forward, they now need to start paying £100 a month towards that credit commitment, and it's unaffordable. Unfortunately, the customer trips up. We have to educate on managing finances better. £6.5 billion outstanding on overdrafts. And the worst of them all, payday loans. Standing at only £250 on average, but the customer will pay back 1.65 times that amount. It will also destroy the credit file. We have to educate our customers on doing better. And in the UK, we owe £1,600 billion, or 1.6 trillion, and that is forecasted to reach 2.4 trillion over the next 4 or 5 years. So huge amounts of debt outstanding. What can we do as professionals to help people out? So a bit of doom and gloom, but we do believe this is the new normal. What was rare on a mortgage application is now run of the mill. Circumstances that were once unconventional have become the new normal. And these are the interesting cases that are making up more and more of your workload. Now, what we know is that interesting cases are on the rise. Fact. A broker in the southeast said to us, a young couple have come to me for a mortgage. One of them missed a £3.42 credit card payment on their store card 8 months ago, and suddenly they're a specialist case. They're not normal. It's becoming more and more common now that clients don't tick regular boxes, says a broker in London. And another broker in London. My general view is that specialist business is going to progress to become more mainstream over the months and years to come. I absolutely agree with that statement. We've started to see it already. The amount being written through specialist lenders is on the increase. And interesting cases may be easier than you think. This is really interesting when I think about how long does it take to write a specialist case? Well, actually, it's less than 3 hours longer than it is for a mainstream case. Of course, it's a little bit more complex. It might involve a bit more research. So it will take a little bit longer, but it's a lot more rewarding. And I'll come on to show you why shortly. So mainstream cases, 10 hours. Specialist 13. But at Pepper, we are committed to making it easier for you. We've got a fantastic application system, which TFC Home Loans use every single day. So they know exactly how to get the case through and are familiar with the way we operate. The products we have are clear and transparent in terms of the product tiering system. We're always looking at reviewing and improving criteria where we can. And the cases are reviewed by an on-site underwriter that we have in TFC on day one. That shows great consistency and a great understanding of specialist lending. TFC are able to place those cases quicker and more efficiently. So here's where it can generate a greater return for you. Now, if you charge a fee for a mainstream case, what we know is that 47% of brokers will charge up to £500. That's an average of £44 per hour. For specialist business, we know that a higher proportion of brokers charge a higher fee. 35% are charging up to £1,000. £58 per hour. Now, it takes around 13 hours to place a specialist case. You'll earn an extra £14 per hour, £180 per case before any enhanced prop fee. So here are 3 great reasons to seek out those interesting cases. Firstly, interesting cases are on the rise. Secondly, it's easier than you think. It can generate a greater return. And if you're still not convinced with what I'm saying, help people succeed. Think about that customer. The satisfaction of helping that customer onto the property ladder who has had some adverse credit or has had a troubling time, or you're looking to reshape their finances with some debt consolidation. It's certainly, in my opinion, a lot more satisfying than a bog standard high street case. Pepper was created because of a need. A lot of people being held back by the existing system. I'm a big believer where mainstream mortgages stop, we start. So let's take a look at our interesting cases. Up until October this year, 23% of the business we wrote included CCJs, 37% self-employed, 15% of our business is first-time buyer, and 57% has some sort of adverse credit history, whether it be as basic as a credit score fail, or whether it be as severe as a debt management plan. So that's a whole 3/4 of the business we do in Pepper, which doesn't have any CCJ attached. And that is driven through criteria and service, which I'll come on to shortly. So let's have a look at Pepper products in practice. I'd like to go through a couple of case studies now. So the first one is an application to raise capital for debt consolidation by 2 applicants. Nikki and Jacob had a life event within the last 2 years, and it resulted in 2 CCJs totaling £25,000. The 2 CCJs were registered 13 months ago, and they require 80% loan to value. Well, what's great for Pepper Money is that we don't have a pound value limit on CCJs, and we will accept as recent as 6 months ago. They also don't have to be satisfied. So this particular deal we did on a Pepper 12 product. Pepper 12 meaning no CCJs in the last 12 months. Our second case study is an application to remortgage an existing main residence by 2 applicants. Robin is a day rate contractor. Christine, aged 59 and unemployed. They're looking for 60% loan to value over 15 years, and they want interest only with a repayment vehicle of selling the mortgaged property. So there's no adverse on this particular case, but a combination of criteria has sent it to Pepper. So firstly, day rate contractors we do, minimum £200 a day, take the day rate times 5 times 46 weeks. The applicant needs 12 months contracting experience with 3 months remaining on the current contract. For the interest only part of this deal, we go up to 60% loan to value, and we do accept sale of mortgage property to repay the debt. And there isn't a minimum equity requirement either. The next case study is to purchase. 2 applicants are looking to buy property. Isaac, self-employed, trading for 1 year. Oliver is employed on a basic salary with high monthly commission and had a payday loan which expired a year ago. First-time buyers, and they're failing the high street credit score. How often do we hear that? So this is a typical case for Pepper. We don't credit score, so we're not going to decline someone on points. We do 1 year self-employed, so it works perfectly for applicant 1. We'll also take the latest year in isolation if the business was trading for longer. And we take all of the monthly commission at 100% as long as it's regular. And that will be based on a 3-month average times it by 12. And our final case study is an application for a buy-to-let remortgage by 2 applicants who are looking to capital raise. Maria and Luke are 72 and 70 respectively, and they have £18,000 of income. They have 8 properties between them, and they're looking for 80% loan to value over 12 years. So in this particular example, Where Pepper have been able to help is on a strong pay rate buy-to-let product. So we stress at 140%, irrespective of tax banding. And then on our 5-year products, we are a pay rate lender, which is great when it comes to squeezing as much equity out as possible. There is a maximum of 9 properties in the background, but we won't stress those properties if they're washing their own face, which is great if you've got 1 or 2 of those properties which are a little bit highly geared. We're satisfied if the portfolio is self-funded. So if you've got an interesting case, we and TFC are very much interested in helping. The products are transparent and simple to follow. We start at Pepper 48 being the most prime product, and we end at Pepper DMP, Debt Management Plan. All you need to understand is when did the applicant have a registered CCJ, default or mortgage arrears, and then it will fit on the time period for the tiering system. So what's our mission been for 2019? Well, it's been mission possible. Defaults in CCJ shouldn't be getting in the way of your client and their mortgage. The range that we've introduced, Pepper 6 to 24, is as follows. We've reduced the rates on some 5-year fixed rates. We've introduced 0 completion fee options. We've got flexible criteria for multiple CCJs. There isn't a pound value limit, as I mentioned, and they don't need to be satisfied. And we will accept as recent as 6 months ago. In these interesting times, thrive with TFC Home Loans and Pepper Money. And I'd now like to take any questions. Thank you for listening. So if you do have a question, please type it into the question section. I have had one question come up already. What type of adverse are you seeing most of? Ooh, well, we see quite a mix, to be honest, when it comes to adverse. I would say CCJs are becoming more popular. As we talked about earlier, with the rise of CCJs, we're starting to see a lot more people, especially with smaller amounts of CCJs. But when you get to 2, 3, 4 of them, it becomes impossible to place it with High Street. So we're starting to see applicants who have had CCJs a lot more recently, but for lower amounts collectively. What's great and fair is that we're still able to price it realistically to help that applicant. So you're looking between 3 and 4% if it was 6, 12, 18 months ago. So some really competitive pricing. Question from Peter, do we operate in Scotland? We don't, unfortunately, no, just England and Wales at the moment. And whilst I'm waiting for some other questions, I would say, if I looked at the headline Pepper Money, what do we stand for? Well, it's very much helping any applicant who's had adverse credit, impaired credit, however you want to phrase it. Self-employed and affordability, we're very strong. Affordability in particular, being able to use multiple sources of income at 100% if it's regular. We've really grown our interest-only lending. Because we're going to age 75 at 60%, it's helping elderly clients. And we've seen a spike in the buy-to-let business, very much driven by the pay rates. So just give it to see if any other questions come up. So got a question from Jane. What is the most unusual or unique criteria you have? I wouldn't necessarily say unusual, but we're unique in the way we want to be proactive and manually underwrite the cases. Of course, I understand many lenders manually underwrite, but we're really trying to explore and find that reason to lend when the customer has had a bit of difficulty. So it's important to note we're not a repair lender as such. But if we've got a customer who's had a CCJ 6 months ago and they need a little bit of an income stretch, if disposable income is there, it may be possible for us to do the case. So the criteria we offer is quite broad in terms of income and adverse and self-employed, debt consolidation, all that sort of thing. But where we win the business is a combination of the rate, the service, and the way the underwriters operate. I think what's very helpful, the relationship we have with TFC, them knowing how we operate, we know how they operate, and the fact that we have an on-site underwriter placed in the TFC office, it just gives great consistency and trust in what we're doing and really builds a relationship. So any of these tricky cases you have, send them into the TFC team, which are fantastic, really knowledgeable, and we'll all be able to help where we can. Okay, I'm going to hang on for 60 seconds to see if any other questions come through. Thank you very, very much for listening. I do hope you picked up a few things there about the specialist market, about TFC, about Pepper Money. We are available if you'd like to know a bit more as well. Okay, thanks again. Speak to you again. Bye-bye.